So the expected return of an asset depends on the risk of the asset. The expected return of a portfolio depends on the risk of the portfolio. We've talked about this a lot this semester. We're going to denote it as ER, expected return, and the greater the risk, the greater the expected return, all else equal, or in a flat world curve. So again, the idea being that the more there's risk, the greater the expected return. And we're headed towards where we're going is which risk is relevant and how does it tie into expected return. So that's where we're headed. But we've talked all semester long about expected return, and it's related to the risk. The actual return or realized return of an asset or portfolio, it's a return that actually occurs, and it's denoted as R. So kind of enter into a day, and this is what we expect the return to be, and then the world unfolds, and this is the return that actually takes place. And guess what? Sometimes those are different. In fact, they tend to be different. The actual return is often different than the expected return. And why is that? Unexpected surprises. Maybe a little bit redundant there. Unexpected surprises. So the actual return is equal to the expected return plus this U term, which is the unexpected return. So the actual return is the expected return plus the unexpected return. Unexpected return is based on unexpected surprises. So if there were no surprises, then the actual return that we would see would be the same as we expected to see. However, there are surprises. News comes out. Could be good news, could be bad news. If it's good news, then this will be positive and the actual return would be higher than the expected return. If that's bad news, the unexpected return would be negative and the actual return would be less than the expected return. So when we talk about new information, it has an expected part and an unexpected part. Part of the reason why we emphasize unexpected surprises. So an announcement comes out, there's an expected part and an unexpected part. So we go in and let's say the government's about to announce inflation data. The expected part is what the market expected the government to announce. And that is what had been anticipated. And what's important in our world is that's been taken into account by investors. So when we look at the price of stocks before that government announcement, what inflation was the market expecting? And the values of the stocks before that announcement reflect anticipated or expected inflation. Oops. Then the announcement comes out, and there may be an unexpected part that reflects surprises. Those are things that differ from expectations. And that is what drives unexpected returns. And we'll talk more about this, but basically, if we were expecting inflation to be announced at, 2.0%, and the government came out and said it was 2.2%, that's 0.2% higher than we had expected, and that may lead to a reevaluation of values. So 2 is kind of the expected part, the extra 0.2 is the unexpected part. An important element that we don't take into account is the resolution of uncertainty. So in practice, if the market thought it was 2 and then it comes back to actually be 2, that has relevance because now there's a resolution of uncertainty, but we don't focus on that in Finance 301. We assume that what had been anticipated is reflected, and there's the unexpected part, which is the part that differs from what we expected.